conceptual framework for financial reporting. So the main reasons for developing an agreed conceptual framework: it provides a framework for setting accounting standards, a basis for resolving disputes, and creating fundamental principles, which then do not repeat it over and over again in accounting standards. So before we had the framework, we prepared the standards basically based on nothing. So some of the standards were the same as other standards. There was a lot of repeated information. There was a lot of unneeded information. You can kind of look at the conceptual framework sort of like the Constitution and our laws based on the Constitution. Well, our standards are based on the conceptual framework. So the conceptual framework, you might think of it as the Constitution for accounting, that the accounting rules have to follow the guidelines set up in the conceptual framework. So it was started back in 1973 to give us a good theoretical basis for the development of accounting standards. The problem was that when they started this in 73, they already had prepared a bunch of accounting standards before 1973 without a conceptual framework. So there's a little bit of an issue with that. But anyways, they released 8 framework statements between 1978 and 2010. I believe 3 of them have been rescinded and replaced with newer standards. So we're going to talk about the need, why do we need this, how it was developed, an overview of it, and then we'll look at first, second, and third level objectives and concepts and measurements. All right, so need for a conceptual framework. So we want a coherent set of standards and rules. So the coherent set of standards and rules will be based on the original conceptual framework to solve new and emerging practical problems. So the framework gives you kind of a basis to study problems and to solve those problems, and then to avoid rewriting standards. Because if the standards are not based on a framework, then they really have no foundation. All right, so a little more detail on why we need a conceptual framework. Build on and relate to an established body of concepts. All right, so you have concepts like related to quality of information. All right, and concepts related to how we measure information, and concepts related to the reliability and relevance of the information. So we want to build on those concepts. We want to build our statements on those concepts. Issue more useful and consistent pronouncements over time. So if they're based on a conceptual framework, they are going to be more useful and they definitely will be more consistent. It'll allow us to increase financial statement users' understanding and confidence in financial reporting. The conceptual framework tells the user why these concepts are important, why it's important that the information is relevant, why is it important that the information is useful to investors, why it's important that the information has representational faithfulness or reliability. All right, multiple choice. Soundly developed conceptual framework of concepts and objectives should increase financial statements users' understandability and confidence in financial reporting, enhance comparability among financial statements, companies' financials, allow new and emerging practical problems to be more quickly solved. I would say all 4 of those are correct. So all those answer choices are correct. Here are the 8 concept statements. Number 1 was superseded by number 8 as well as number 2. So 1 and 2 are gone. I guess number 4 is gone. We don't even have that up here. Number 3 was superseded by number 6. So the ones that we have left are 6, 7, and 8. And 8 basically was the first 2 concept statements that were issued in 1978, that updated. All right, so the first level of the conceptual framework is just your basic objectives. Second level might be the most important part, I think, as far as your takeaway from this chapter. Qualitative characteristics and elements included in the conceptual framework that are needed for preparing new standards. And then the third level would be recognition, measurement, and disclosure concepts. All right. So down here, the first level, I guess lowest level on the chart, but we might consider it a higher level, like the why, purpose of accounting. Provide information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors in their capacity as capital providers. So give them the information that they need in order to prepare useful financial statements. Right? So you want to give them what they need through standards and these concept statements so they can prepare financial statements that are useful to their users. All right, we'll be talking about these two in a few minutes. So let's talk about the first level. Useful to present and potential information, right? That's useful to present and potential equity investors. So we want our companies like IBM to prepare statements based on our financial accounting standards, which are based on our concepts, that provide useful information so they can, the users, the investors, potential investors, creditors, so forth, can make the right types of decisions with respect to that company. All right, in the conceptual framework for financial reporting, what provides the why, the purpose of accounting? And that would be D, right? The objectives of financial reporting. That's why. Why do we prepare financial reports for our users? We want them to have good information. We want them to make good decisions. We want them to be able to understand what our company is. We want them to understand our company's cash flows and our company's income, so forth. All right, second level, which I think this would be more of an important takeaway, is the fundamental concepts. So we have primary users, and this really comes from, I guess, the first level. And the constraint is cost, in that you're not going to prepare this thing unless the benefit is greater than cost, somewhat tempered by the fact that we are required for publicly held to prepare financial statements. Pervasive criterion, decision usefulness. So is the information useful for decisions that investors, potential investors, creditors, customers want to make on your company? The fundamental qualities are relevance. This used to be called reliability. Now we call it factual representation, but it's basically the same thing. Is the information reliable? Faithful representation. Is it reliable? So is it based on something objective? All right, so for it to be relevant, it has to have predictive value. So it has to predict future results. So we're showing that over 5 years, income has gone up 5%. So maybe in year 6, income will go up 5%. Confirmatory value. So it confirms what the user already believes. I believe IBM is a good company. Now I see their financial statements. Okay, now I believe it in more because of their financial results and their income and balance sheet and statement of cash flows. And then materiality. So some things are not material and probably are not going to be included. Financial statement really is quite concise. So things that are not material, may not be in the financials. It might be, if it's important, it might be in the disclosure notes, but probably will not be in the financials. All right, on the faithful representation side, or the reliability side, is the information complete? So everything that should be there is there, including the notes and disclosures. Are those complete so that users have a good understanding of the organization? Is it neutral? And that's hard, because people bring in their own biases, right, when preparing information, even preparing standards. FASB brings in their own biases. And then is it free from error? And of course, that's hard as well. One thing that we do with publicly held companies is that in order to look at the quality of the information, that they have to go through a rigorous audit, right? An external audit by a CPA firm, Big Four firm such as PwC or Ernst & Young. All right, then down here, the enhancing quality. So even more quality. That's comparable, it's verifiable, it's timely, and understandable. And some would argue with timeliness because normally financial statements are not issued until maybe 90 days after the December 31st year end. FASB's conceptual framework, qualitative characteristics of accounting information include which of the following? It looks like C would be correct. Faithful representation, which is reliability. All right, let's look at relevance in a little more detail. So predictive value. So does the information, will it tell us what will happen in the future? Does it give us some foundation as to what's going to occur in the future? All right. Can we confirm? Does it confirm what we already know? As I mentioned, okay, I got the IBM report. Now that confirms my understanding that IBM is a good company. I can see now through the report that they have high income and good cash flow and strong balance sheet. All right, and then materiality. So are things that are material, are they highlighted in the financial reports? All right, so relevant means that the accounting information must make a difference. So that information must make a difference in the things, in the decisions that the decision maker makes. All right, so predictive value. So as input to predictive processes used by the investors. So investors are performing expectations. We think income is going to increase by 5% or cash flows are going to increase by 10%. Does this information give us that predictive value? Do we agree with that? Conceptual framework's qualitative characteristic of relevance includes predictive value, sure. Second, confirmation. Does it confirm or correct prior expectations? So I mentioned earlier IBM. Okay, confirms our prior expectations, that's a good company. Or it could correct. Maybe we thought it was a good company, and then we see that they have a net loss. They have a bunch of stuff in disclosures about lawsuits that are impending. I'm just making this up. This is not IBM. So XYZ company. So it could confirm what we know, or it could correct our expectations. Confirmatory value is central to the concept of earnings quality. It allows investors to verify or change the prior assessments of a company's performance. So earnings quality really is related to what the investors think of that company, right? Because what the investors think means that they're going to invest in that company, they're going to be a creditor for that company, they're going to buy stock in that company, they're going to be a supplier for that company. So that earnings quality, if we have good earnings quality, if we have good earnings and it's quality earnings, it's been audited and so forth, that's going to lead the investor to make decisions, hopefully, that are positive with respect to that company and buying the company stock or being a creditor or being a customer of that company. And then materiality. So if we omit something that's material, that's going to be misleading to the user. So we include all things that are material. Okay, things that may not be material now, but may be material down the road, probably should be a disclosure about those items. A lot of these things that we're talking about rely on the judgment of the accountant and judgment of the auditors. Conceptual frameworks, qualitative characteristics of relevance. You did this one already. Includes predictive value. All right, then faithful representation. So, and this really basically says, okay, is this information reliable? And there's three parts to that. Is it complete? So everything is there in the financials and in the notes of the financials and disclosures. Is it neutral? So in other words, it's free from bias of the preparers of the financial information, and then free from error. So completeness, all information is necessary for this to be reliable is provided. Okay, so I have all the assets are listed. In order for us to know what, we have to have reliability, faithful representation of what our assets are. I have to list what the assets are and what the values of all those assets are. Same with liability and same with equity. All right, cannot select information that might favor one set of interested parties over another. You look at the Enron situation. They were trying to put a good bent on the information. Okay, so they were trying to make themselves look good. They're trying to make their shareholders look good. But we have to think of everything, even potential shareholders. So we have to have the information that's neutral. We have to think of everybody when preparing this information. We don't want to favor our shareholders over potential shareholders. Which of the following is an ingredient of faithful representation? And neutrality would be an ingredient of faithful representation. All right, then free from error, it's more accurate. It's obviously going to be more reliable, more faithful representation of our information if it's free from error. Part of that is why that we have a CPA firm for publicly held companies audit the financial information. All right, and then the enhancing qualities. So everyone is using the same standards, so that makes the information much more comparable. According to standard accounting concepts number 2, which was superseded by 8, completeness is an agreement of the fundamental quality of faithful representation. It's not part of relevance. Verifiability occurs when independent measures using the same methods obtain similar results. So two people doing the same transaction come up with a similar result, or the auditor and the financial accounting doing the same transaction. Maybe it's a a large transaction in the General Journal on a bond that was issued. So they're both going to do it together, separate. And so the accountant says, oh, it was $1 million of bonds that were issued, and the simple example in the auditor comes up with the same amount. So it's verifiable. Okay, so using independent measures, or two different people come up with the same result. And that's part of the audit process, in that you're trying to verify the information provided by the accountants. Characteristic that is demonstrated when a high degree of consensus among independent measures using the same measurement methods is verifiability. All right, timeliness is that the information still has to be valid, still is useful to the decision maker in making decisions. As I mentioned, sometimes that is criticized. Timeliness is criticized because the financial statements in reality come out maybe 90 days after they've been prepared because they have to go through the audit process. Company A is issuing its annual financial reports within 1 month of the end of the year. An example of which enhancing quality, probably timeliness, because normally it takes about 3 months to issue those financial reports. All right, then understandability, quality information that is reasonably informed users see the significance. So we can understand it. You're reasonably informed. You have an accounting education or a finance education. You understand the information. You know what it means. You can use that information to make decisions. So it's understandable. It's not above the reasonable user. It's not above their head. All right, then the basic elements in the second level is from concept 6 and defines 10 interrelated elements. And of course, assets, liability, equity, moment of time come from the balance sheet. Investments by owners, of course, that would be something that would be shown on the retained earnings statement. Distribution to owners, retained earnings statement. Income, revenue, expenses, gains, losses, of course, all would be on the income statement. Just some basic assumptions that you hopefully read about in the chapter. Economic entity, company keeps its activity separate from its owners and other businesses. In other words, you don't use your personal checkbook when writing a check, right, to your business. When you're writing to a supplier, you don't use your personal business. You keep your personal business separate from your entity. So if you are a small company, you'll use QuickBooks. You have your own bank account. You have your own checking account. Right? You have your own information, budgets, and income statements and balance sheets that are separate from what you're doing in your home. Going concern lasts enough to fulfill objectives and commitments. Not much of an issue in our course, but in the audit course, you will talk a lot about going concern, because you feel like a company cannot last 12 months, you probably cannot give an unqualified opinion on the financial statements. Monetary unit, of course, dollars, money is the common denominator. Of course, now we're moving into Bitcoin, so we're going to see how that affects the monetary unit. And periodicity, we can divide our economic activities into quarters, into years. So periodicity, meaning that December 31st normally is the year-end financial statement date of most companies. Most companies are 12 months for their financial statements, 3 months for their quarters. Few questions. Which of the following is not a basic assumption underlying the financial accounting structure? That'd be historical cost assumption is not a basic assumption. These other ones, economic entity, going concern, periodicity, which we just mentioned, those are underlying basic assumptions. Historical cost is not. What accounting concept justifies the usage of depreciation and amortization? That would be going concern assumptions, right? We're going to have an asset we're going to depreciate over 10 years. We're assuming the company will be in business 10 years from now. All right, and then some measurement principles. So these are not underlying assumptions, but they're measurement principles. Historical cost, which is used for fixed assets. Fair value, which might be used for stocks and bonds and so forth. Recently, FASB has taken a step of giving companies option to use fair value as a basis for measurement of financial assets and financial liabilities. So it's a newer thing. Normally, everything was done historical cost, even stocks and marketable securities and so forth. But the FASB does allow us to use fair value for certain liabilities and certain assets. Valuing assets at liquidation value rather than cost is inconsistent with which of these? Historical cost principle. Okay, so normally, things like fixed assets, buildings, machines, so forth, we don't record them at liquidation value, record them at historical cost value. Hopefully that gives us more objectivity. That's debatable. Revenue and expense recognition. So revenue recognition require companies to recognize revenue in the accounting period in which the performance obligation is satisfied. So I talked earlier about unearned revenue. Actually, I talked about it in Chapter 3. So unearned, I will talk about in Chapter 3. Unearned revenue, we don't record revenue for that, right? Because we collected the cash, say $100. We're supposed to maybe rake someone's lawn for $100. But we haven't done it yet. We're going to wait a week till maybe the leaves fall. All right, so I'm not going to record that. I'll just record that as a liability. And unearned revenue is a liability. If I did rake the leaves and they paid us $100 that day, then I would record it as revenue. Expense recognition, let the expense follow the revenues, or the matching principle, match expenses with the revenues that they generate. Revenue generally should be recognized when we do the job. Performance obligation has been satisfied. Accounting principle of expense recognition is best demonstrated by matching effort, expense with accomplishment. So it's matching principle. Like if you remember in cost accounting that we use cost of goods sold, match that with revenues. We do all the work, let's say in January, to make the product, and then in February it's sold. So the cost of goods sold would be in February. All that work was done between January 1st and January 31st. So that work is kind of following the accomplishment. All right. This is just, I'm not going to go through this, but you can go through this just as a good example about Boeing going through a revenue recognition. And basically it's when they sell the planes. When the planes are sold to United is when they should record revenue. Full disclosure, so through the financials, through income statements and balance sheet and so forth, and also through our notes, and then any supplementary information we might have in our corporate report. Cost constraint, so the cost must be less than the benefits. That's tempered somewhat by the fact that we're required to prepare this information. Following two situations represent application of the cost constraint. Raphael Corporation discloses fair value information on its loans because it already gathers information internally. Willis does not disclose information because the cost of the information is greater than the expense of getting it. Now, some things, if Willis is required to denote the value of that information, then they should. All right, so there's just a summary of this, and then as far as the IFR stuff, I'm not going to cover that, but you can read through that. All right, so if there's any questions, please, I have my email and my phone number at the end of this PowerPoint slide. Please give me a call. Thank you very much for your attention. Good luck in your studying.